let me see. Oh, is this one? Valentina is here. Oh, this is automatic thing here. Okay. Okay, guys. So let me test again if I remember. Okay, guys. So up to now, what we have been doing in financial accounting, what is going on? In financial accounting, so we are working on financial accounting, okay? And the most important thing that you need to remember, guys, all we have been doing up to this point is that assets equals liabilities plus equity, right? So this is an identity that we always need to satisfy, right? And what we have been doing is using Excel. We have been creating basically a mega accounting. So it's called the Italian method. And what is interesting about the Italian method, guys, is that it provides you all the financial statements that we need. So we have, in the first part, we have cash, do you remember? So if you consider this part here, is your cash flow. So all together, and then at this part here, we have the revenues and expenses, remember that? So this is going to be your P&L. This is going to be your cash flow. And all together, so if we consider all the things together, it's going to give you what? It's going to be the balance sheet. Right? So this is what we are doing now. And so let's go back to the Excel file. I was preparing, I need to finish it. I was preparing one more example for you so you can work on that for next week. I will send this to you maximum tomorrow. Just to be sure that you are able to understand and to redo what we have done. Okay, but as usual, guys, if you are able to replicate what I've done here in class that we have done in class, you're going to be more than well prepared. Because what I've done is all the transactions are basically typical transactions that you're going to find in real life. And if you know them, I'm pretty sure that you can manage everything else. Okay, so let me open my Excel. Can you open your Excel, guys? I think we didn't finish. Let's finish this one here and let's do some more analysis and discussion about the midterm exam at the end of the class. Let me show.
When is the midterm exam again?
Yeah, the midterm is going to be November 4th or 11th. Okay, let's see how do we move. But you're going to have 2 weeks at least to study. And the midterm is going to be up to financial accounting. So this is the last topic of the first part of the exam. Make sense? Mm-hmm. Okay, so I think you have this file, right? I think I sent this to you, I shared this with you. Correct, guys? So everyone has this file. If you can verify, can you verify these numbers just to be sure? Cash 3887. We can take a look to this number here. Is my loss is 11,582. Do you have this Excel file so we can move from there?
Yes.
Okay. Yeah, perfect. So the easy thing to do, guys, remember this part here, as I was mentioned to you, so the revenues and expenses creates your P&L. Okay, so this one here. Well, we can do the cash flow, but the cash flow is a direct analysis of what you have here. So this part here, this is your cash flow, guys, directly. Okay, make sense? So basically, the information that you get here, you can summarize this cash flow if you want different stuff. But in general, what the cash flow tells you is how much money, how much cash you have currently in your corporation. So at this point, I have $30,000 in cash. Right? So let's go to the P&L. I think we finished this one here. I'm not sure. Have we finished this one here? Do you have these numbers here? Guys, do we have this?
Yes.
Okay, perfect. So basically, guys, this is the basic structure of the P&L. So I have my revenues, I have my cost of goods, I have my gross margin is 13,000. I have my sales and marketing, 2,000. I didn't have any research and development here. I have general administration, 7,000. I have depreciation, 10,600. So my operating expenses is basically this part here, all the expenses that I need to make in order to support my activities. In this case, are equal to $19,600. So my income from operations, from here I can see, guys, that I'm losing money already. So I created 13,000, I spent 19,000, so I'm a negative 5,902. Well, I have interest income or expenses, so I have incomes that I need to pay, interest I need to pay. Extraordinary income or expenses, guys, are all these type of income or revenues or expenses that are not directly linked to the business. Okay, so for example, selling a machine or selling equipment that is not your business. You are selling this because you know what, perhaps the machine is already old, or you have an opportunity, or you need liquidity. Everything is called extraordinary. Okay, so this is not this revenue, but can create some positive money here. Well, in this case, it's a negative money. So the income before taxes is 11,582. Of course, the income tax only considers positive values here. If it's negative, it simply pays 0. Okay. Well, now it's not 0.03. Now in USA, 0.21. But in any case, we don't have anything. So my net income, guys, is 11,582. Right? One way of checking if this work is correct, guys, is that you need to see this number once 11,582 in here, this part here. Okay, and how do I get this number here? Well, it's very simple. It's my expenses minus my revenues. So this number here, 11,582 must coincide with the P&L, because the P&L is simply an aggregation of the main account of all the accounts in the revenues and expenses. Questions, guys, up to now? Questions? No? Okay, perfect. So now we have the P&L. The next statement that we can do is the balance. Okay, and the balance is simply just taking a look to the field values and then just using the totals. Okay, that's all. It's very straightforward process. So let's do cash. Okay, so we do equals my cash here. So I have 38,817. Enter. Let me move this a little bigger. So this one here, guys, is simply field C43. Okay. Then I have my accounts receivable. So let's take a look if you have accounts receivable. Well, I have 0, but in any case, I simply click here. Are you with me, guys? Yep. Yes. Perfect. So what I do is now is inventory. So if you can see that the names also coincide in general, 12,000. Prepaid expenses, I don't know if I have them, but let's take a look. Prepaid expenses, I have 1,000. Okay, normally here I can add also short-term investments in the short-term assets. I can add short-term investments here. I haven't, but you can, because I don't have anything here. You see, short-term investments are nothing, but you can add. Okay, so if you want your balance to be more complete, you can simply add one more column. So we can, let me move this perhaps. So I will add that. And this is short-term investments. And my short-term investments, in this case, I don't have anything, but in any case, I can just prepare that, short-term investments. And be sure that the sum here, guys, includes this new number. Okay, of course, as soon as it's 0, nothing changes here. Do you have questions here? Nope. Perfect. So we can take a.
I don't have short-term investments for line 11. I have total current assets. Is that something I have to add myself?
No, we haven't.
Or should it be?
Yeah, no. I just added this one here. Yes, that's what I've done. So just insert column.
Okay.
Yeah, insert one column, one row, and then you simply type short-term investments, and that's it. Can you do that very quickly so we all work together? We all move together.
Okay, done. Okay.
Yep, excellent. Okay, and you can add, guys, as many other accounts here. You know, if you have whatever, if you want to divide inventory into in process, raw materials for sale, you can do that. Okay, but you simply start expanding this one here. But this is the basic structure. Okay, so do I have other assets? Okay, sorry, I don't have anything. Fixed assets at cost. So let's go to fixed assets. Well, in this case, guys, I have multiple things. Do you agree? I have this one plus building. And where's my plus? Plus building. Okay. This is normally what is called fixed assets, but sometimes you can have buildings or you can have equipment. FF&E, this is equipment basically. So I have equipment. So my equipment equals this one here. So it's fixtures, furniture, and equipment. So this is FF&E, is fixtures, furniture, and equipment. I have $30,000. And I have an accumulated depreciation. Let's take a look of this number. Yeah, okay, we're gonna come back soon. Just make sense to you what I've done? Okay, perfect. So now let's go to liabilities. So we are going to start talking about, so we have finished all this part here, that is assets, fixed assets, etc. So now what we are going to start doing, we're going to start talking, taking a look to liabilities. Okay, so we have short-term, long-term. So it's basically up to here. So basically we're going to focus to this part here. So I have accounts payable, so equals, where's my accounts payable? Accounts payable, well, I have 0. I have accrued expenses. Well, I don't have this accurate interest here, so it's simply 0. Okay, so if you want, we can eliminate this one here, it doesn't matter. Current portion of debt. Remember, we had a bond. So, what is that? Here. Current portion of debt, short-term interest. Well, in this case, we have 0. Then we have income tax payable. Where is my income tax payable? No, I don't have income taxes also. So basically it's 0. So I don't have anything here. However, what I have is unearned revenues. Agree with me? So my unearned revenues equal 6,000. So what I can do here, so what I can do is sales taxes payable better here. So we can, because that's something that we have been taxes payable. And this one here, well, this is a rounding error. They agreed at 0.004. So I just need to be sure. I just need to be sure that the sum is like that. It's going to be a small difference later. Okay, are you with me, guys, up to there? In long-term debt, I only have the bond. So where's my bond? Long-term debt. This one here. And then with this, I'm done. You see that? So I have already done the liability side, the short-term here, the long-term here. So all my liabilities are going to be basically this one here. Well, I don't need so many cents, basically this one. Okay. Now we have, do we have capital stock? I don't remember, but let's take a look. So capital stock, guys, is what the owners have at the end of the day. So this one here, I just have common stock. Okay. If you have a preferred stock, you simply divide this in common and preferred stock. Then I have treasuries. I think we have treasuries. Yes, we have treasuries. And then, guys, this is the way the balance sheet communicates with the P&L. Remember, they communicate through the retained earnings. Got it? So this number here, guys, equals what you get in the P&L as a net income. Okay. So why is the difference? Because these two guys need to be equal. Do you agree? It's because normally, guys, here, as soon as I have a negative number here, what I need to do here is simply to write a positive number. My formula was wrong. I imagine in the past I used this positive. But so you need to change simply that formula. Let me put this in a more decent way. Here we are. Everyone is with me. So remember, guys, that the way you check that you are correct is that this number must be balanced by this number. Make sense?
Just a second, sorry, mine is not balanced and I'm looking at.
Yeah, take a look, take a look. You know, we have time.
Missing.
We have time. We need to be sure that everyone gets the same numbers. Let me know where you want my mouse to be so we can click there. So remember what I told you is that the formula here in B19
Yeah.
is wrong. So
It must be plus. Oh, okay, I see.
It's plus, exactly.
All right, now it's the same number. It's balanced. Thank you.
Yep. Everyone, guys? Yep, everyone is here.
Yeah.
So as you have seen, guys, from this data, you can build this one here, and automatically these two can be updated. Got it? It's extremely simple, guys. It's really, I use this one in real life. I don't know, when was that? It was a 90, perhaps 98, 99, I don't remember. I was a CFO of a very, very large hospital, and I created a system that worked beautifully. And the system was this one here. It was, I'm telling 97 guys, the systems were not as developed, the databases and all this stuff were not as developed as now. But, you know, very simple stuff can be extremely useful. And also my students in development world, they told me that this is extremely useful for helping development people. So, you know, local communities, microfinance institutions, is extremely simple, guys. Got it? So I want you to really understand this part here, understand how the accounting works and how you can transfer this into two pieces or three pieces, basically, guys, that everyone understands. P&L, balance, and the cash flow is basically is this part here.
Professor, for P&L, we should remember, right, which transactions we should be looking at to calculate for the midterm.
You need to, you don't need to remember anything. You need to, I will give you these ones here. So
Okay.
empty. Do you remember how we started this one here? I give you empty. Yeah, I will give you exactly the same.
Okay.
So what you need to do is you need to understand, oh, what is revenue? Where do I get the revenue? Where do I get the cost of goods, etc. I don't trick you guys. If you really understand the accounts that we have, the transactions that we have done here, these transactions look crazy and sometimes don't make a lot of sense, but indeed these are the transactions that you must know for sure.
Yeah. Yeah, I by the way have a
Sorry.
I would still like to go through like two or three transactions that I did at home, and then for some reason 2 or 3 of them didn't make sense to me. So.
Please, let's do this because let's take this as a review also for the exam, because this is going to be part of the exam. Tell me where do you want me to focus? Which one?
Let me see. So for me, the problematic ones were 11.
Okay, so this is 11.
17. And 24.
Okay, let's do 11, 17, let's do 11, 17, 24. Okay, let's do 11, guys. You help me. Okay. So this says, oh, I had so we need to go back to 117, well, 19, imagine. So this one should be 19. So let's go back to transaction of 117. 117, this one here. Okay, so we need to link this one with 11, correct?
Mm-hmm.
Okay, so in 11, on transaction number 5, we bought merchandise. Okay, so 5,000 were cash and 12,000 were on credit. But the total value of goods really is 17,000. Do you agree with me? It doesn't matter how do you pay. The value of the merchandise is 17,000. Agree with that?
Yes.
Okay, so let's go to 5. So we need to see that we have, okay, I have my 5,000 cash, I received 17,000, and I have accounts payable 12,000. Okay, so this is clear. What is interesting from here, guys, is that you have, this transaction is open, and this is something that you're going to sell in the future, but you owe money. You owe $12,000 to someone that you need to pay in the future, correct? Okay, so now let's go to 11. Now, what I will do is I will pay from the 12,000 I owe, I will pay 4,000.
Mm-hmm.
Okay? So how much money I will be owing? 8,000. So this 8,000 is purely information. However,
yeah, that's what confused me.
Yes, this is pure information because I have already the 12,000 in the book in here.
Mm-hmm. Yes.
Okay. So the only thing that I need to do is I will pay 4,000. So this implies that I will decrease my accounts payable that I have 12 minus 4 is what? 8,000. So the 8,000 is simply information. So you don't need to know anything here. This is simply, you know what? This 5% is going to be, the 8,000 remaining from the 12,000 is going to be a credit for the next 30 days, for example. But this one here is going to create a 5% interest rate annual. So the interest rate is 32.59. Okay, so let's do this. What is my 11? And then what I need to do, guys, I need to consider these 32s. As soon as I'm not paying the interest rate right now, I will pay this in the future. I need to consider this one as an interest payable. So this 32 corresponds to the 8,000 that is the difference between this and this. And immediately I consider this interest expense, this interest payable as an expense. So that's the way you cancel, you register the interest rate. Make sense?
Mm-hmm. Yes.
Okay, so the 8,000 guys is simply, you don't need to do anything because it's already here. It's this one here. 12 minus 4 that you pay. The remaining $8,000 is what you have as a debt for the future. Okay, questions? That's clear, 11 is clear?
Yes.
Okay, so now let's do 17.
Yes, 17.
Okay, let's do 17. Okay, so this is the bond thingy here. So what I will do is I will issue a bond for buying long-term equipment, for buying equipment, $30,000. What I will do is I will have a bond. Remember, the bond is part of your exam, guys. So what I will do is I will pay coupons for it's going to be coupons, four coupons, 3% each coupon. Okay, the face value is 30,000. So, and the coupons, guys, are going to be simply 3 times, for 3 times, it's 9,000 or 900 per year. Do you agree? Guys, you agree? It's 3%
yes.
of the face value. So it's $30,000 times 0.03 is 900. And you're going to pay, okay, so let me be sure that you understand this. Guys, that's why we did bonds also in class. But let's remember that. Where's this one here? So what I'm saying in terms of the bond, what I'm saying is, okay, I have 1, 2, 3. My face value is 30,000, correct? So I will pay, oh yeah, this is my 30,000. So I will pay 900 each year. Correct? This is what my cash flow is. And apparently it's a par value because I will receive $30,000. So it's a par ball. Now, what is interesting, guys, from the bond in terms of accounting is that we need to distinguish 2 pieces of the equation. This one here, the 30,000, is considered long-term debt. Do you agree? Because you're going to pay this after in more than a year. Agree with me?
Yes.
Okay. Now, what happened about what about the coupons? Well, the first coupon, the one that is going to be paid in a year, this one here, is going to be a short-term liability. Okay, I think we call it, how do we call we call it short-term, short-term interest. We call it like that. Okay, makes sense to you? Because this is paid during the first year. Now, what happened? Oh, sorry, it's 4 years. Sorry, I need to squeeze here the 3rd year. And this is the 4th year. It's 4 years. The bond is for 4 years. Now, what happens with the remaining 2,700? These ones here are not paid during this year, correct? So these are going to be what? Indeed, they are long-term interests. But here comes an issue, guys. If you put this long-term interest in your balance in the document that we're doing, how do you cancel this 2,700? So if you want to do, what I'm saying is the following.
Can't you pay later and then slowly remove this 2,700?
Yes, exactly. But the thing is that you cannot put this into here. So what I mean is that
that's what confused me.
You cannot put it here. Why? Because remember, if I that's why I said long-term interest. So imagine that I connect here my 2,700. I write here my 2,700. So what is the only way I can eliminate this part here? How do I eliminate this one here?
Underneath it, whenever we pay back, just put it in. You mean in the same time?
You need to balance this one here.
Yeah.
So the only way you can do that is you can consider this one as an expense. Do you agree?
But
agree with me or not?
Yes.
So this is the only way you can do that.
But
However,
it's not
guys, yes. However, here comes an issue. So remember, let me go back to my whiteboard. If we do that, so if we consider this one here, okay, if we consider this as a long-term interest, then what happens is, this is a very big if. Then I need to, the only way I can disappear this one is with an expense. Do you agree? So I need to do a 2,700 expense here. Agree? So who do you think is going to complain? The expenses, what is the effect of expenses, guys? Exactly. The expenses reduce taxes.
Mm-hmm.
Yes or not? So
Yes.
the IRS is going to say, wait a second, this one here is not for this current year. This one here is for the future. So you cannot take this part out. You need to take, you cannot consider these expenses that are going to happen in years 2, 3, and 4 as current expenses. So how do you do that then? Because you need to clean, your balance is not going to be balanced if you don't do something here. So that's why, guys, what happens is that you don't consider this 2,700 in the balance sheet. You write this as a note. Okay, so what is a note? If you see a balance sheet, guys, okay, so if you see balance sheet like that, and then you have all the accounts, and from time to time, what you're going to find is, for example, 1. And here, for example, you find 3, etc. And then below, that's why they are called notes. They're going to say a long-term bond or 4 years. Well, normally, this is going to be something like that. This is going to be a very simple explanation for this one. So they're going to say 4 years bond, you know, annual coupon, annual coupons, 3%, principal or face value is what it was, 30,000, okay, and 2,700 should be second, third, fourth years. Yeah, year coupon, something like that, and that's the way it should go. So, you know, basically the ones that are looking for your balance are going to say, oh, yeah, I understand. So you have paid just 900 because this is the current interest for the coupon, for the bond. And the remaining ones, even though they are not here, because you cannot consider them as expenses, you are considering them as a note. So if I'm an investor, I'm a portfolio, financial analyst, I can see, oh, I understand what is happening here. You see, simply you need to communicate that to all the interested parties. Make sense?
Yes.
Okay, perfect. Okay, so now we can go into the details of how do we process this one. Yeah, so let's go 17. Okay, I have, you know, this can be directly, so you don't need to do that, but I done that just to explain. So my bond, I received my 30,000 cash, okay, and then I need to record this one as so I need to delete this one. Okay. I need to record this as a bonds payable. This is a long-term liability. I need to record my short-term interest, 900. And as soon as this is going to be paid in a year, the expenses of 900 are okay. Make sense? Okay, so this is the only way you record this one here. Now, what do you do with the 30,000? Well, I use the 30,000 to buy equipment. So that's why you have minus 30,000 increases equipment by 30,000. Now, if you want, you can do this, you can net this one here. And sometimes you appear 0 here and immediately go $30,000 here. So you disappear this column, this row here. But you know, it's much easier if you simply do this way. Okay, I receive my money, I spend my money in equipment, and that's it. Questions?
Dr. Ngifa, I wanted to find out, is there any other way to verify your, how do I put it, your input besides the control column? Because the control column is nice, but the thing is I can put my stuff in the wrong place and still get 0 and think.
Oh, yeah. No. The other side is knowing what you're doing. Seriously. So you know what? Yeah, you're right. You can put this one here by mistake in land. You can. Okay, no, but you know that in real life it's very tricky. Perhaps in an exam you can make a mistake like that, but in real life, no. In real life, you know what you're doing with your money, you know, or the business corporations. Yeah, And also remember, guys, that these names here are the standard names. But I have seen other colleagues that use their own names. Okay, this one here, guys, is extremely useful because you can do crossing with accounting. So that why I'm using the same names as accounting, because what I used to do, guys, is I simply ask the accountant, okay, give me your balance up to this month. And so I simply cross-check. I have mine, I have his or hers. And then I can see, you know what, there are significant differences. If there are small differences, okay, we're okay. But if you see significant differences, then you say, wait a second, where's the difference? In cash, the difference is in here. I forgot something here, or he forgot something here, or there was a miscommunication in this one here. This is crucial, guys, because from here you control everything. Seriously, okay? Okay, questions about 17 is clear? Guys, 17 is clear?
Yes.
Okay, so now let's go to 24, you said?
Let me check. I don't remember what I said. I think yes, 24.
24. Okay, so what is required capital? This is asset buybacks. These are the famous, sorry, I don't want to delete this one. This is what the people now is talking a lot, buybacks. Have you heard about this one here? So what happens, guys, is that corporations, so let me show you, where's my, here. So what corporations do is I have my, where's my, here we go. I have my stock, do you agree? So in this case, my stock was $200,000 equals to 200,000 shares. Make sense to you? So, and sometimes the corporations are liquid, guys, and have enough liquidity that they can buy their own stocks. Got it? Well, in this case, I'm buying at par. So this implies that I'm buying 2,500 shares at $1 each. So it's basically the owners are not making any money. Makes sense? Because you invested $1 and then you are being paid $1. So basically you don't have capital gains. Make sense to you?
Yes, I think my concern with this was that I didn't quite understand the difference between common stock and treasury stock in this case.
Oh, yeah, no. Yes. Common stock is the stock that the owner has in his pocket. Okay. So if I own 50,000 shares, I have the 50,000 shares. And not necessarily in a paper, but I'm the owner of 50,000 shares. I'm as a person. Agree? And what is a treasury stock? Is the stock that a corporation owns itself. So in this transaction here, guys, the following happened. The corporation paid 2,500 to buy 2,500 to buy where is this one here? To buy 2,500 stocks. Got it? From me, that I'm the owner. So I will give the corporation.
Took it away from shareholders.
Exactly, and put it in the corporation.
Okay, got it.
Exactly that. And so this decreases the stocks that the shareholders have, and this is considered an expense for the corporation. Okay? So why do you think the corporations do that? And why do you think the governments are saying now, after the crisis that we're living now, corporations should not be allowed to buy back their own shares? Why do you think this happens? Why buybacks are kind of, you know what, this is not good? Why?
I watched watched a YouTube video about this. It was like
yeah, go ahead.
So a lot of CEOs have short-term tenure. So like one of the best ways to increase the stock price, which is a function of their bonus, is buying stocks. Because if you buy stocks and you're removing it from the market, there will be less stocks in the market. Though, and if all things equal, the demand equal, then less supply, then the price would increase. But they're not doing anything to increase innovation or putting
exactly. Yes. Okay. So this was number 0.
Yeah. So like they're
no
just
economic impact.
Yeah. No innovation, but they're just increasing the stock price.
Do you agree, guys? So they are not doing a real investment. So they are, instead of using the money in research and development or growing the business or investing in plants or investing in whatever in the corporation, in another corporations, what they are doing is simply they are removing resources from the economy to buy back paper, okay? And indeed, by buying back paper, guys, these guys don't buy a small number of shares. They buy tons of shares. What they do is they increase the demand of their own shares. Of course, what they are doing is they are increasing their own price. Okay, makes sense to everyone? Okay, what other reason? Another reason that is very important, guys. Taxes. Okay, so let me explain you how this works. Imagine, guys, that you are an owner, okay? So you are the owner. If the stock price goes up, okay, so the difference between the, okay, let's do P1. P1 minus P0, the price is my capital gain. Do you agree? Agree with me, guys?
Yes.
Okay, and capital gains are taxed at a capital gain rate. So this is more or less 15% tax rate. Got it? So if I don't make money, if I don't have capital gains, it doesn't matter. Now, what happens if indeed the price increases by a lot? So imagine that I buy here at 1, and then the price goes to 3. So this is P0, and this is P1. So what happens in that case? My capital gain is going to be 3 minus 1 equals 2. And my tax is going to be 15% of this. So what is that? So my tax is going to be, nah, it's not 3, 0.3. So this is my tax, correct? Guys, you agree?
Yes.
Okay, so what happens? Okay, what happens? Why this is beautiful? Why not dividends, for example? So let's do, okay, so this is capital gains by this one here. What happens if it's, let's compare this versus dividends. Imagine that the dividends are $2. Okay, so what is the tax rate for dividends? Dividends, guys, are like income. Got it? So income are subject to income taxes. And income taxes, guys, the marginal rate. So if you make more than $400,000 or even more than 2 million, etc., the marginal can be with all these numbers is more or less 33% and up. Do you see that? So what is the best strategy for you as the owner? Receive dividends or receive capital gains?
Capital gains.
Capital gains. Okay, so this is the third reason, guys, is that the government say, wait a second. So this is a loophole in our system. By having the capital gains lower than the income tax, then basically we have created an incentive for individuals to create this type of capital gains, do you agree? Versus dividends. Because the taxes, the tax rates are significantly lower in the capital gains. So the incentives of creating buybacks are very high, right? And what is more beautiful is that buybacks, by buying our own shares, the prices increases by a lot. So basically the capital gains are going to be much higher. The rates are going to be lower, so I make more money compared to this one here. It's a good strategy. So that's why the discussions always are, why don't we simply capital gains? That is also an income, just tax at the income rate, and that's it. No one in the world does that, guys. Okay? Now, what is the logic of that? It's basically, there is no logic, actually. Why? Well, lobbyist, some logic there. I have no clue why they have done that.
Why what?
Why they have this differential interest rate, differential taxation rates? What is the logic?
Maybe they want to incentivize capital gains so that they would.
Yeah, but you know, remember the capital gain and the income. So what is the difference between capital gains and dividends? Technically, both of them are income for an individual, right? They represent income to the individual. So why they should be one called capital gain and the other one income? If both are the same logic for an individual. The logic at the very beginning in the 70s, when the taxes started being discussed by a lot, is that we want this corporation, what we want is corporations to, basically individuals to invest in corporations for longer period. Okay, now let me give you one logic. This makes sense, no? So I want you to invest in your corporation, but I don't want you to be buying and selling every single day. No, it's not, that's not a capital gain. But if you buy and then you stay longer in a corporation, so this implies that you have your money in the business and the money is going to be producing more business, okay? What is that? The period, the minimum period you need to have your investment is 1 year. It's not too bad, right? So if you keep your money for a year, one day after 1 year, you are going to be able to do this 15%. Got it? So the 1 year apparently is not enough. I think it was at the very beginning 5 years, and then it moved to 1 year. You know, slowly was moving to 4, to 3, to 2, to 1. And soon, let me tell you, this is going to be 0. So you can buy and sell this at the capital gains. It's amazing. But okay, makes sense to you guys? Do you understand?
Yes.
Okay, so this is treasury basically, because when you remove assets from the owner of the stocks, you need to keep it in a corporation. These are what are called the treasuries. This one here, treasury stock. Questions, guys? Okay, other questions, so we can continue. Okay. No more questions. So let's go to the ratio analysis. So how do we do our ratio analysis, guys? Well, once we have our balance and P&L already done, so the ratio is simply just copying you have here the names. So let's do net sales. Oh, sorry, I need to do net sales. So I just do, we're in an income statement. So net sales equals P&L. Income statement or P&L are the same. Is this one here. And then I simply copy here, sales and marketing. I have it here. Guys, do you understand what I'm doing?
So we're just directly copying, right?
Exactly.
So
we are just simply copying.
New
Exactly. Yeah, exactly. So just allow me to copy all these numbers. You just need to be sure that the numbers are exactly the same. And that's it. Okay, everyone is here. Guys, clear? Okay, so let's first fill all the documents and then we go and analyze these ratios. Okay. So let's do the same with the balance. So the cash, this one here. We need to be careful here, guys, because we have added a couple of accounts here. Accounts receivable. Yeah, I have it here. Inventory, I have it here. Where's the other one? Prepaid expenses. Prepaid expenses, I have it here. And what I've done is I have added, so I just need to be careful because I have added one addition. So do Control X, guys, just cut, insert one more. And then what I've done is I have added short-term investments. This is equal to 0, so it's not a big deal. Be careful, you need to modify your formula here. Just need to increase the sum up to here. And I can just copy here. Okay. If you can do this up to there so we can move together. Okay. I will do the other assets. Oh, other assets. I'm sorry, other assets. Yeah, I don't have any other assets here.
My percentages are off for some reason.
Oh, let's first compute all the numbers and
okay.
So I have fixed assets, FF&E, and accumulated. Let me see. Yes, so we agree 224. Sorry, 224. Yes. Okay. So let's finish all this one and then we go into the details of the numbers. Let me do this. I can do the same with accounts payable. Remember, guys, that we have problems here. We have added a couple of accounts. We call, instead of income, is sales tax payable. I don't need this one here. Then I have my long-term debt. That is this one here. I have my capital stock. Is this one here. And then we simply copy and we just need to be sure that indeed all the numbers match. 188.14. Yeah, it's okay. And this number matches this number. Perfect. I think we have it all. Can you please let me know when you are done with this part here? Good. So everyone. Okay, guys. So let's go and take a look to the ratios. These ratios here are really important, guys. When you have the income statement of P&L, what you normally do is and it's not net sales. Yeah, let's call it revenues. Okay. Well, it can be net sales also. The people call net sales. So everything is going to be with respect to this number. So this 100% is going to be this number divided by the same number, but every single number is going to be linked to this number here. Okay. Can you just use no decimals just to be sure that we have the same numbers? So let me move this a little larger. You get these numbers? So how do we read these numbers? Basically here what we are saying is that from the 100% of my revenues, 42% is my cost of goods. So this implies that after considering my cost of goods, 58% remains with the corporation. So this is my gross margin. Now, what is my most expensive expense is basically, well, depreciation is nothing to do, but general administration is 30%. It's a very large number. Okay. Normally, how do you decrease this number, guys? This proportion here, you need to increase this one here. Because normally what happens is that general administration, at the very beginning, is very, very tough. You have a lot of people. But remember, the marginal contribution of each of these individuals increases, okay? So this is productivity. So that's the idea. If you start producing more, so if you imagine, okay, I will do this times 5, and you keep the same employees, you see, decreases by a lot. Then you have income from operations is minus 25%. So I'm already losing 25% of my revenues. And at the end, guys, I'm losing 49% of my revenues. Make sense? So these numbers here are very useful when you have 2 years to compare, for example. So you can see, oh, last year was 30% in general administration. Now we are 25%. So that's good. So we are improving, okay? We're improving 2 ways. One, that we are decreasing these expenses, or second, we're increasing our revenues. Make sense? So it's a very simple, straightforward analysis. In the balance, these numbers are more just for observation purposes. These ones here are useful, but these are simply for observing. So normally what you do is you link everything to the total assets here. For example, 17% of my total assets is cash. No, a current asset is 23% versus 77% of my long-term assets. So I'm liquid enough, so that's okay. Now the liabilities, guys, you compare this versus my total shareholders and liabilities. So, and this is the capital structure that I was telling to you guys. So this plus this is my liabilities, do you agree? 16% I have debt, or, short and long-term debt, and 84% corresponds to the money of the corporation, of the owners. So this is a very strong cash balance statement, guys. So 84% belongs to the owner. So if you want to get loans from this type of corporation, you should be able to do that, right? Because the capital structure is very strong towards equity. Banks are not like that. Banks can be 1% or 2%. So 1 or 2% is the investment of the owners, and the remaining 99% is made by deposits, for example. Make sense? Guys, questions? No questions? Clear? Okay. So here, yep.
So in the midterms, how will it, like, how it's gonna be, like, how it's gonna be structured? it's going to be similar to something like this. So when we,
yeah, it's going to be very, very similar to this one here. You don't need to memorize this one. So, you know, you're going to remember this when you start working. At this point, what I want you is to understand the logic and to understand how the numbers come, where the numbers come from, and that's all.
Oh, okay. So sorry. So we're going to have to memorize all these ratios and.
No. You're going to receive. Remember, this was empty. Everything was empty. Yeah, you're going to receive something like that, empty.
Oh, so at the very start, there's going to be data, and then we're going to fill it up, and then we're going to do the balance sheet and the P&L, and then do the ratio.
Yes.
Okay.
Yes.
So something similar to this. Okay.
Yeah, something. I don't know if we are going to have time to do the ratios in the exam, but at least what I would love to do is if you can do this and this for sure. Okay.
Okay.
These are the most important things, guys. And then this one, the ratio analysis is also crucial. I will explain you in a minute. So let me show you my other screen. Okay, so let me. Okay. Okay, guys. So what happens is that you want to know at any point in time, how are you doing in your corporation? Do you agree? So that's why we're going to use several ratios. Okay, let me do this part here. I will divide this in 3 pieces. I will divide this in 2 pieces. So this is my short-term assets, my long-term assets, my short-term liabilities, my long-term liabilities, oops, and my shareholders' equity. Do you agree, guys? And then I have my P&L around here. So one of the analyses that we do with the P&L, guys, is what we have done right now. The percentages, everything in respect to the revenue. So this is one of way of doing that. And the second important analysis that we do is comparing, for example, this is 2019 or 2020 versus 2019. So you start checking in this way. Got it? So you check this way per year, and then you check this way comparing years. Now, what is important for a corporation, guys? What is crucial for a corporation? What?
Profit?
Yes. Okay, the profits are here. Profitability. Okay, so profitability, basically, you simply take a look to the profits, net profits, but also you consider the gross profits, and then you need to understand how you can be decreasing other expenses to maximize your profits, your final profits. Do you agree? Yes, profitability is crucial, guys. But you can have a corporation that is extremely profitable, so in paper, so you can have an invention and you know that this can produce you 300% in a year. And this is beautiful, do you agree? So you can have a very profitable project. However, what is really crucial, guys, for everything that you do in your life is the short term. So this one here is more related to I would say medium to long term. Now, when I say medium to long term, guys, I'm talking not 10 years, I'm talking about 1 or 2 years maximum, okay? Something like that. The first one, guys, is basically liquidity. Liquidity. Okay, why liquidity is important, guys?
Sorry, can I interject?
Yes, of course.
So the P&L focuses on the profitability, while the balance sheet, or P&L is the income statement, right?
Sorry? No, yeah, P&L or income statement is the same.
P&L or the income statement focus on profitability, while the balance sheet looks at liquidity.
Yes, and another one, yes, that's correct. Up to now, yes, that's correct.
Okay.
Okay, so what is liquidity, guys? Why liquidity is very, very important? Liquidity is a term that is necessarily related to short term.
Need money to fund day-to-day operations.
Yeah, exactly. You need money to do that. I always ask my students, you know what, guys, imagine the following example, okay? And you participate with me. I will give you for sure, okay, for sure, $10,000. You don't need to do anything. I will give you each $10,000. There is only one condition. Are you ready to participate? $10,000, what is the profitability for you? As soon as you're investing zero, $10,000 is the internal rate of return is infinite. Do you agree? Agree with me or not, guys?
Yes.
Yes. Yeah. So what is the only condition, guys, is that you don't breathe for 10 minutes. Do you agree with me or not? Of course, the profitability is beautiful. But you know what, 10 minutes is very, very few people in the world can stay without breathing 10 minutes. So you know what, you can have the most brilliant idea, the most brilliant plan, almost secure plan, but if you don't have money at the very beginning, you are done. You are out of the business. Got it? So, and this is also for your personal decisions in life, guys. Sometimes you have very good decisions and you want to have 99% of everything. And then you are going to be missing that, because have you heard about this one? It's better to have a buck in your pocket than 1,000 never with you, something like that. So you need to be very careful on understanding what is your liquidity and how important is liquidity to do something, okay? Now, how do we measure liquidity, guys, in accounting? Well, liquidity is short-term. So basically we focus our efforts in this piece of the equation, in this piece of the balance. Do you understand? Okay, so let's take a look to a couple of them. So a couple of them, guys, are these ones. Liquidity ratios, the current ratio and the quick test or acid test. So what is the logic here, guys? Remember, it's simply it's trying to find, sorry. Oh, come on, out. What we are trying to do, what is current assets in here? Well, my current assets, if you go here, is this part here. These are my current assets. And I compare this with my current liabilities. So basically, do I have enough money to cover my short-term liabilities, my short-term debt? Do I have that money? So it's basically, if you see $52,000 versus $6,000, of course, you have a lot. You agree? So that's why your current liabilities, guys, here equals 8.67. So what is the meaning of 8.67? Is that your current assets cover 8 times your current liabilities. So you are very well protected. Now, if you take a look to the current liabilities, guys, you can argue that not all this is really, really liquid. You know, perhaps short-term investments, if you have Amazon in your portfolio, of course, is very liquid. But if you have one share from, I don't know, Russell 5000, for example, and liquidity, you can get liquidity, but you can go to a market and you can wait 2 weeks for getting the money, so it's not liquid. Another thing that is not liquid, for example, is inventory, guys. Yeah, I have my inventory, but it's not easy to get to the market and simply sell all my inventory, okay, without a significant discount. So this is not so liquid. Prepaid expenses is definitely not liquid, you see, because you have already paid this one here. Going to your provider and asking, please, can you return the money to me is going to be very tricky. Got it? So that's why we simply enforce a little more the liquidity concept here. And then we use, this is the ACT test. It's simply cash plus accounts receivable divided by current liabilities. Okay? And normally, if you want to be more strict, normally the accounts receivable are the accounts receivable in the next 30 days. Because you can have accounts receivable in the next 60 or 90 days, or perhaps sometimes 120 days. Got it? So what is the meaning of this number 2 here? The larger this number, the better. So this implies that your cash and accounts receivable cover 6 times your current liabilities. Again, your liquidity is perfect. Based on these 2 ratios, guys, your liquidity, you don't have issues with liquidity. So you are okay there. Questions about these ratios here? It's clear? Yep, perfect.
Yes, yeah.
Excellent. So now let's go to another one. Okay, so liquidity is the first one that is really important. The second one, guys, that we are going to analyze is called solvency, also called leverage ratios. So, and this one here, guys, is related to the capital structure of the corporation. So basically, guys, what we are going to be analyzing is this part of the balance sheet. It's basically how good your position as a corporation is in order to get more credit, in order to get debt, short and long-term debt. Got it? So this is called solvency of or leverage. So let's take a look to what we have in Excel. So we have it down there. So debt to equity, guys, is simply all the debt, current plus long-term debt divided by shareholder equity. So this number here, guys, it is a very tricky number. So in general, a lower number implies that you have more of your owners than debt. So in general, guys, this is a good signal for the banks or lenders to give you money. Okay, I'm telling you in general because this depends on the business, on the sector, and the industry where you are working, on. If you are in finance, this can be a very, very small number. But if you are, for example, in manufacturing, this number can be a decent number. Got it. And another one is that this is also famous, and this one relates basically both sides of the equation. It relates. It relates. So the first one was the yellow, so short term plus long term divided by equity, and the other one, guys, is also but it's also yellow. It's going to be. How do I do this? It's going to be this part here. This part here. It is also solvency. It's basically what percentage of your assets have been financed by liabilities? Okay, so what percentage of your assets have been financed by liabilities? That is very related to this part here, to equity side of the equation. Let me see that. Let's see this one here. Of course, guys, in this case also, normally the lower the better, correct? Because my liabilities have financed only 16% of my total assets. Now, these two are in general kind of related, okay? Kind of related, not necessarily related like that, but yes, they are kind of related. Questions, guys? Now let's go to profitability ratios. So now let's go to profitability ratios, guys. Well, one of them is a return on sales. Basically, what I compare is my profits. If I compare my profits with my revenues or sales, this is my return on sales. Okay, so what percentage of my sales come to my pocket? That's the idea. Make sense to you? So you want obviously this number to be the largest possible. Return on sales. Then we have the gross margin, guys. Remember the gross margin was here. So what was the gross margin? It's simply the revenues, basically revenues minus the cost of goods. Obviously, guys, you also want this number to be as large as possible. Because remember, below the gross margin is where we have all the other expenses that help the corporation to work. And there are other two ratios of profitability, guys, that compare the returns on equity. So this is returns on equity, the famous ROA. So it's simply how much profitability, how much profits I created with respect to the investments, to equity. Sorry, it's ROA on equity. And also to compare my profits to the complete, so perhaps I can do this in a different color. And the other one, is my profits compared with the total assets. This is my return on assets. Of course, the larger, the better. So this measures basically productivity of assets. And this one here measures the productivity of equity. Make sense to you, guys? The return on equity is simply the profits divided by my equity. So it's so my investment, what is my return of my investment as owner? Got it? And you normally compare these guys with other alternatives that you have, or investments that you have. So imagine this corporation produces 10%, got it? But you have another investments that produce 20%. So in that case, you need to be thinking, is this a good investment? Perhaps individually, no, but perhaps as a portfolio, yes. But this is the type of information. And the return on assets is simply how productive are your assets to produce more money for you? Because remember, at the end of the day, you want profitability, okay? So, and you need to have assets that are providing you enough capacity to add value and create value. Make sense to you guys? Guys, questions?
Sorry. So ROE, is this the same with ROI, or is it a different thing?
Sorry, you said, okay, so we have this one here. Sorry, this one here is the ROA.
Yeah. No, I mean ROE. I mean, so return on equity, is it the same as ROI, or are these different?
No, wait a second, let me. This one is this one. And this one here is this one here. And they are different.
No, I mean, sorry. So return on equity, so ROE.
Yeah.
Is this the same as ROI, so return on investment?
Yes. Yes. They are exactly the same. The investment is assumed, you know, the ROI is normally by short-term investments. When you do an investment, for example, in Amazon, and just for 6 or 7 months, you use the ROI, because investment is thought more like a kind of short-term thinking, and equity is more used in the corporation world, but they are meaning exactly the same.
Okay.
Okay. Here, of course, guys, it's negative because my profit, my net income or profits are negative. So that's why all of them are negative here. The only one that is positive is my gross margin, that we have seen that. Of course, my net sales minus cost of goods divided by net sales, 58. But as you can imagine, guys, what you want is these numbers to be the largest as possible in absolute, in real numbers. Make sense to everyone? Questions, guys? No questions? Okay, so let's go to another one. And these ones here are more management oriented. You know, you have inventory turnover. It's simply the sales divided by the average inventories. So it's basically how many times you are selling in a year, say. How many times your inventories in a year have been sold? Well, in this case, 2 times. Of course, this number, the larger, the better, because this implies the following: you buy, you sell, you buy, you sell, versus buy and sell. You know, the business is buying and selling as fast as you can. Got it? So who are fantastic doing this stuff? You know, the Walmart, Amazon type of businesses, they buy and they sell immediately. They buy and sell, they buy and sell immediately. So this rotation, guys, creates a lot of value. Got it? So this is the turnover, inventory turnover. Now, the inventory turnover in days is basically, if I sell if my overall inventory is moved in almost twice per year, how many days in average per each turnover? 189 days, basically. Okay, so it's simply the 365 divided by this number. So normally it takes me 190 days to sell one inventory. Okay, that's approximate. Of course, the larger this number, the smaller this number. Make sense? Now, another way of measuring turnover, instead of using sales, what we use is the cost of goods. Why is better the cost of goods, guys? Because the sales prices can change with the client, can change with the time of the year. So you do, for example, some price discounts on July, and you price increases during Christmas and New Year's. So you see the sales prices change dramatically. Normally the cost of goods don't change like that. Normally the cost of goods are more stable than the sales. But the information is basically the same information. But the people prefer to use the cost of goods versus the sales because the volatility of sales can distort this number here. Okay, in this case, I have my cost. So my inventory turn is 0.8. Then we have my asset turn ratio. So this implies basically how many times my sales how many times I need to sell in order to create all my assets. Again, the larger this number, the better. But it's very tricky, guys. You know, I think Walmart has around 25%, Amazon is around 35% in these asset turn ratios. You know, receivable days is if you have debt. In this case, we don't sell a credit. But basically what it measures is in how many days I recover the money or I collect the money from my clients that I gave them credit. Simply that. You want this number to be as small as possible. If I give you a credit, I prefer to give you a credit for 15 days versus 90 days. Okay, of course, this depends on how big you are. Okay, how big is your reputation and etc. If you are a small guys, this number is going to be very, very big. For example, if you want to sell to Costco, Costco is going to pay you in 90 days and sometimes in 120 days. But if you start building up your reputation and your products really sell, basically they can decrease from 120 days to 30 and sometimes they can pay you in 2 weeks. Okay, so that's the measure here. Okay, guys, I think that if you understand this logic here, it's going to be more than enough for you to be prepared, not for the exam, guys. Just take this not as an exam. Take this as your real life. It's extremely useful, extremely simple, and this is going to put you in a level of talking with accountants, for sure, or financial and analysts, guys. You understand this part here, you are going to be talking with these guys like nothing. It's going to be very simple to understand these guys. It's going to be very simple to contribute or to create your own systems like that. Okay, so this file is crucial. So what I will do is, you have the same numbers. Can you verify that you have the same numbers before I go and talk to the exam about the exam for a minute?
Is there any way that you could send us this again?
Oh yeah, I will send you this file here, but I want you to be sure that you understand what I'm doing.
Because yeah, the only thing is that there are some that are off and I want to go back but right now we don't have time to do that.
Yeah, yeah, I agree. So let me use this one here. Okay, here you go. Okay, so guys, what I will do is I think today I'm tired already. So tomorrow I will work on creating one example that you can work on this and then just try to understand everything. Okay. Questions, guys, so we can talk a little about the exam now. No questions? Guys, questions? Nope. Okay, guys, so let's talk a little about the midterm very quickly. No surprises.